What's going on, everybody? I wanted to start the 2025 on a high note, because we're going to be getting rid of some of these debts and obligations and controlling them and becoming our natural role, which is the creditor. All right, so I wanted to go over some things. I appreciate all of you guys for following, subscribing, watching this channel. And if you're not a follower or subscriber of this channel, you know that you can just hit the subscribe button and you can hit that bell button so you can get an update anytime I release. Remember, I got a lot of these in the chamber, so I got a lot of videos for you coming in 2025. It's going to explain a lot of stuff. But I want to explain certain terms because people use these terms in a certain context, and I want to make sure that you understand. So I'm going to bring you through ChatGPT, and then I'm going to show you what a credit default swap is, and I'm going to explain it to you. Okay. So a credit default swap is a financial contract that acts as like an insurance policy for loans or bonds. It allows one party to transfer the risk of the borrower or bond issuer. Sounds familiar, doesn't it? Defaulting on their debt to another party. Here's a simple breakdown of how it works. Now, does this sound familiar when you go to a car dealership or when you get a house? When you start a credit card agreement, when you do a loan, it's the same thing. Key elements of a default swap: protection buyer. The party that owns the loan or bond wants to hedge against default risk, pays a periodic fee, like an insurance premium, to the other party. Meaning, I'm not even going to get into that yet. Okay. Protection seller. The party that agrees to compensate the buyer if the borrower or bond issuer defaults. See, you're the issuer of the bond, or the bank is. See, the bank is the initial issuer because they created it. And once you signed and did the transfer, boom, defaults. Earns the periodic fee in returning for taking on the risk. Reference entity. The borrower or bond issuer who whose default risk is being insured. Could be a company, government, or entity issuing debt. Credit event, specific event that triggers the CDS, such as a default on debt payments, bankruptcy. So when you get into the loan, it's already in default. Oh, the way they structure it. They structure the loan to go in default in its inception. So what it is they structure it so, like, they structure it for you to accept and settle it, but they leave it in default and transfer it, and then they say, "Okay, you collect on it for us." And that's basically what they're doing. It's crazy. Okay, agreement. The protection a buyer and seller agree on the terms of the CDS, including reference entity, e.g., company XYZ, the notional amount, the value of the debt being insured, the premium fee the buyer pays, usually expressed in an annual percentage of a notional amount. Listen, what they telling you what everything is. Premium payments. The protection buyer makes regular payments quarterly to the protection seller for the life of the contract. So the protection buyer and the protection seller is who you have. Listen to these terms. When I'm speaking and doing stuff, you need to listen and study. Who is the buyer in the agreement? You don't know who's who. That's why you don't understand what action to take. Who's the buyer? Who's the seller? Oh, the dealership's the buyer, the seller. Then now you look at this equation and you're like, oh, now I understand how to deal with it. See, you can't do anything until you have understanding. Nobody, no matter of how long my videos are going to be, no matter of how good my information is or how bad it is, you have to come into your own level of understanding because you can't act until you have understanding, or you can act without understanding, but it's likely gonna not go well for you. Okay, premium payments. The protection buyer had already read that. Credit event, we already read that. Okay, payout. The protection seller compensates the protection buyer by either cash settlement, paying the buyer the difference between the debt's face value and its reduced market value. Sounds familiar, doesn't it? Did they tell you we're doing a credit default swap? No. They told you we're doing an installment agreement. Hold on. That's why when people try to say it's fraud, I say it's not fraud. Fraud, you have to prove intent. Misrepresentation, you can just prove it with the evidence. All right, physical settlement. Taking the bad debt, defaulted bonds from the buyer and paying the full face value. If no credit event occurs, the protection seller keeps the premium payments and the contract ends without any additional obligations. Let me walk that back again. If no credit event occurs, right? So when I told you guys that credit transactions are supposed to be paid by credit, not cash, you have a claim to the proceeds of the cash that you paid into your agreement. Why? Because it's a commingling. Real life example scenario. A bank lends 10 million to a company XYZ, but worries about the company defaulting. To hedge its risk, listen what they're saying. The bank buy all these people. They go to the Federal Reserve. They don't have to. They don't have to go to the Federal Reserve to do this. They don't have to go to the Federal Reserve window till after 90 days of default under the safe harbor provisions. They don't have to go to the Fed for this. They can do this all in one account. To hedge its risk, the bank buys a CDS from a financial institution. So banks buy collateral debt securities. They do it all. They do it all the time. That's what banking is. It's buying and transferring collateral debt securities. So this I got a video that I'm going to prove to you that everybody who's talking about gold and silver don't have no clue what they're saying. And I'm not doing this to just undermine stuff. People have to learn the truth. You have to. Okay, from a financial institution, e.g., an insurance company, for a fee of 2% annually. Okay, so when you go to the dealership, you don't know the deal that them and the bank worked out. Outcomes. If company XYC defaults, the CDS pays the bank $10 million minus any recovery value. So you see, like the bank is not going to lose anything, or if they do lose it, they're covered in their losses. All right. If company XYZ does not default, the bank pays the $2,000 annual premium and the contract ends. Why using a credit default swap? Hedging risk. Banks, investors, or companies use CDSs to protect against losses from defaults on loans or bonds they own, but they can't own them. Why can't they own them? It should be that they hold. They don't own them. The banks ain't owning no property besides like the property that they actually physically possess and own. They don't own no property. They just holding it. So if you're broke, it's your bank's fault. It's not your fault. But you have to take the initiative to know that. So you're like, hold up. I remember I was sitting there talking to some of the small businesses in my hometown, and I was sitting there talking. I was like, "Do you guys actually go to your banks and cultivate a bank relationship?" And they was like, "No," but they wouldn't listen to me. So every time I told them good advice, they would act like I was like I have four heads. That's why you gotta find. You only speak to people. If you're trying to teach this information to somebody, only speak to people who are listening to you. Everybody else, let them find it out the hard way. Speculation. Investors who don't own the underlying debt can buy CDSs as a bet that the reference entity will default, potentially profiting if the credit event occurs. So, do you understand what's going on when you buy a loan? Do you know that they're betting against you? They selling a put option on you and you don't even know. They're selling a put option on you and they're betting that you're not going to figure it out. Portfolio management. Financial institutions use CDSs to manage credit exposure and comply with regulatory requirements. Advantages of CDS. Risk management provides insurance against credit risk. Flexibility can be tailored to specific debts or risks. Profit potential. Speculators can profit without owning the underlying debt. Okay. Do you know what is going on at the closing table? You don't. That's why they say another sucker just came up in here. That's all they betted on suckers. The whole game is bet on suckers. Just don't be one. You even go to the bank, they hand out suckers to suckers. All right, so risk of credit default swap. Counterparty risk. The protection seller may fail to pay if credit event occurs. So if you stop paying them, what they do is they take your agreements and then they use it as an asset on their books and they can borrow against it. If I have the potential to make money, I can say I have a note that's $100,000 on the books. So can you. I ain't even gonna get into that. So systemic risk. CDS has played a major role in 2008 financial crisis due to the excessive speculation and interconnected exposures. This is back in the day when countrywide, what's the other one? Oh my goodness, I can see the bank, I just can't see the name of it. I remember Countrywide and World Savings and all of that stuff. That's when I started working for my company. Um, that's when I started becoming a foreclosure. Well, no, after that, 2009 is when I started working for a mortgage company. And that's when I started to learn collections. I went from everywhere from mitigation, short sale, collections, HAMP, HARP, all of that stuff. So I pretty much been through loan modifications, setup, all that stuff. So like when it comes to banking, I pretty much damn near know how they set up all their loans because I had to testify to it. That's why when I was telling people, don't say nothing you can't prove because if you can't prove it, they're gonna look at it as frivolous. So understanding the terms and triggers of a CDS can be difficult. Okay, summary: the credit default swap is like issue insurance for loans or bonds, transferring the default risk from the buyer to the seller. The buyer pays premiums and the seller compensates the buyer if a credit event occurs. CDS can be used for risk management, speculation, or portfolio balancing, but they carry risk, including counterparty failure and systemic instability. So, when you understand what's going on, you'll have a better level of how you should structure your letters, structure your claims. Okay, please read the UCC and read how to structure a claim. Don't just do stuff because like, oh, I'm about to get evicted tomorrow, blah, 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 blah. Okay, if you try, you need to learn something very quick to stop that eviction. Okay. But then you're gonna have to pick up and still learn. So you're gonna run from people to people and looking for a savior when the savior has always been you. And with that being said, everybody have a great week. Be productive. Enjoy yourself. Enjoy your life. Enjoy your family. Enjoy everything you got on around you. Because none of this is guaranteed. I'm out.